This chapter will touch on how to calculate a company's cash flow. In other words, we're going to find out how much cash a company has. We will use some formulas and come up with how much a company has in terms of cash. You already know basic accounting and financial statements, so let us briefly go over balance and income statements because they are the basis for cash flow analysis. The balance sheet is a company's current value on a particular date. Of course, this value continually changes because the company keeps making decisions. This is balance sheet identity. This is the company's assets, which is a combination of liabilities and company equity value. Liquidity. There are two conditions. The two conditions are how quickly can you change an asset into cash, and the second is to do it without losing much value. For example, if you have a certain company stock, you can change this to cash by simply selling the stock. Now take a look at your house. Can you sell your house quickly and without losing much value? Sometimes you have to wait. Each of the two asset examples have different liquidity. Even in a company, assets have different liquidities. Some are more liquid than others. Typically, current assets are more liquid and long-term assets are less liquid. Of course, liquid assets typically give the company less return than fixed assets or less liquid assets. Liability or company debt is a company's obligation they have to pay. Stockholder equity is the company owner's money in the company. It is a residual claim. They have to wait until all other stakeholders are paid. For example, a company makes money from an operation. The company must pay the debt holders first as interest payment, and then taxes and other debt. The owners can then have a piece of the money that is left in the form of a dividend. Market value versus book value is important. Finance people focus on market value. The book value or historical value is not as important because we are making decisions now for the future, so the current market value is more important for the finance people. Now that we have talked about the balance sheet information, let's talk about the income statement. The income statement shows how much the company has made. Then watch the expenses and then watch the income after paying interest and tax. This is specific to a period. We call this the accounting cycle. It can run January to December or March to February. Typically, it's 1 year. From the sales, we subtract the cost and depreciation. Then we have EBIT, earnings before interest and tax. We pay interest first. This lowers your company's taxable income. Taxable income is EBT, earnings before tax. This is actual money. You calculate what percent of actual money you pay, not the revenue. From the EBT, earnings before tax, you pay taxes, and the leftover is net income. From the net income, the company pays stockholders, and the company keeps some of the money for the next operation. Net income is a combination of the two. Dividends, which are payments to the stockholders, plus the money the company kept or retained earnings. Retained earnings go back to the company, and the retained earning amount is part of the equity side. Let's use the balance sheet and income sheets for this company. It is a data company, Azusa Engineering. Using the beginning year number and the end year number, we can calculate cash flow. Later, we want to see why the income is not the same as cash flow. If you take a look at the balance sheet information, there are some changes from the beginning and the end. Cash is up and accounts receivables are up. Current assets are up as well. Anytime an asset goes up, except cash, this means money went out. For example, they have an additional $100 million in fixed assets because net fixed assets went up from $400 to $500 million. You are adding additional fixed assets. When you add fixed assets, there's an outflow of money. On the other side, you have more than last year. So long-term debt is up from $400 to $420 million. This means you borrow $20 million. Anytime you borrow money, cash increases. Increasing debt means cash inflow. Look at the income statement. Sales start with $2,000 million, then you pay costs of $1,400 million and subtract depreciation of $100 million. These are not cash payments. It is just accounting law. Doing this lessens the company's tax liability. This gives us the EBIT of $500 million. Subtract the interest of $100 million, and what is left is the EBT, or earnings before tax. This is the taxable amount of income. The amount of taxes the company pays depends upon the corporate tax rate. The leftover money is the net income. The net income is important because the money goes into two areas. Some of the money goes out to the shareholders and dividends, and the rest added to retained earnings. Look at the retained earnings. At the beginning of the year, it was $250 million, and at the end of the year, it went up to $370 million. From the net income, the company kept $120 million. The net income was $300 million, and $120 million went back to the company, and $180 million went to the stockholders. By using the data from the previous slide, we can calculate the cash flow from assets. Cash flow from assets equals the operating cash flow, OCF, minus net capital spending, NCS, minus the change in net working capital. The company has an operating cash flow, how much money the company made from their regular operations. This typically represents the income statement. Using the income statement, we can locate the numbers for the operating cash flow, OCF. OCF equals the EBT plus depreciation minus taxes. In this example, the OCF is $500 million. Next is the NCS. The NCS equals the ending net fixed assets minus the beginning fixed assets plus depreciation. To generate a $500 million income, the company spent $200 million in fixed assets. Now we will calculate the change in net working capital, NWC. The NWC is the change of the current assets end of the year minus the current liabilities at the end of the year, and the current assets at the beginning of the year minus the current liabilities at the beginning of the year. When we subtract the change at the end of the year and the change at the beginning of the year, the change in NWC is $50 million. This company generated $500 million cash from operations. To make their money, the company spent $200 million in fixed assets, $50 million in the short-term area. After we have subtracted the other two, we end up with $250 million cash the company has. Take a look at the net income. The net income is $300 million, but the actual cash the company has is $250 million.